Hello and welcome back to the Geordie Pig Investor channel. Whether you're just starting out or looking to maximise your passive income, this channel is your go-to resource for strategies, insights and the tools you need to grow steadily over time. Hit that subscribe button and join me as we explore how to make your money work for you one dividend at a time. In today's video, I'll be breaking down my InvestEngine portfolio performance for the past month, what went up, what went down, any changes I've made and my thoughts going forward. Whether you're a long-term investor or just getting started with InvestEngine, this should give you some insight into how a diversified ETF portfolio behaves over time. My portfolio is currently split between my general investing account and my ISA account. The reason for this is that up until last year, you could only hold one ISA account at a time, and my main one is over on Trading 212. However, since April 2024, the rules have changed and now you can open multiple ISA accounts. The only condition is that across all of them, you can't exceed the annual £20,000 contribution limit. Since that change came into effect, I've been consistently investing £100 every single month into my ISA account, and today I'll be adding another £100, so make sure you stick around for that. Over time, I do plan to move all the funds from my general investing account across into my ISA account, but I'm already on track for hitting my £20,000 limit, so there's no rush for me to do this right now. As you can see, the ISA portfolio has crossed the £200 in unrealised gains for the first time, and this now means my two portfolios combined are up over £370. And what makes this portfolio unique is that every ETF I hold is a factor ETF. For anyone new to the concept, a factor ETF is an exchange-traded fund designed to target specific investment characteristics or factors that research has shown can lead to stronger returns or lower risk over the long run. Some of the most common factors include value, which is stocks that are cheap compared to their earnings or assets; growth, which is companies growing faster than the market average; momentum, which is stocks that have recently performed strongly; quality, which is companies with solid balance sheets and consistent profits; and low volatility, which is stocks that tend to be more stable and fluctuate less. So instead of simply tracking a broad market index, factor ETFs let you focus on strategies or styles of investing that align with your personal approach. In my portfolio I'm sharing with you today, I think I've built a strong blend of the factors I want exposure to. Now let's take a closer look at how these factors have performed in my portfolio for the month of November. Last month was actually the first month in over 6 months that my portfolio ended up negative for the month, but it was only down just 0.28%, so nothing of a concern. And having said that, if we do compare my own portfolio against the S&P 500, we can see that the Vanguard S&P 500 was down 0.81% in November, whereas my portfolio was only down 0.28%, so it has actually slightly outperformed the S&P 500. When looking at my portfolio closer, we can see my main position is the UC99 Factor ESG ETF, which was down 0.95% for the month, and this is the main position in my portfolio, which I'm slowly building up to around 50% of my overall portfolio. It used to be a 30% holding in my portfolio, but a couple months back I did sell out of my GGRG position and I decided to increase it by 20%, as this portfolio is a long-term portfolio, so I want good exposure to tech-heavy companies. The goal of this fund is to give investors exposure to high-quality US companies that also meet environmental, social and governance standards. It tracks the MSCI US Quality ESG Low Carbon Select Index, which looks for companies with strong fundamentals while also keeping an eye on sustainability. If we have a closer look at the holdings within this one, we can see that Nvidia takes up 10.8%, we have Apple at 9%, and Microsoft are rounding off the top three at 8.5%. And something that's quite interesting within this one is that the sector breakdown has shifted quite a bit recently. Industrials now makes up over 40% of the ETF, which is a huge jump considering technology used to be its biggest slice. Tech is still high though at 28.7%, and then it has a massive drop off to financials, which is around 7.2% of the ETF. The reason I've made this one my largest allocation in the portfolio is because of its strong track record since inception. It's delivered an average annualized rate of return of 18.09% including dividends, which actually means it's outperformed the S&P 500 over that time period. Of course, past performance doesn't guarantee future results, so as always, make sure to do your own research before considering it for your own portfolio. Quick heads up, Snowball Analytics is running a huge 30% off Black Friday sale from November 24th to December 3rd. As a dividend investor, it's been a game changer for tracking payouts, visualizing income growth, and staying perfectly diversified. If you've been thinking about leveling up your dividend strategy, this is the best time of year to do so. Use my link below, lock in the discount, and start growing your Snowball the smart way. And for my existing Snowball users, you can also get this 30% off by using my link and adding it to your current subscription. So take advantage while it lasts and level up your dividend strategy. The second biggest position in my portfolio is the X-Trackers MSCI World Quality ETF, stock ticker XDEQ. This one did see a positive return this month, but only just, being up 0.25% or 27 pence. It tracks the MSCI World Sector Neutral Quality Index, which targets developed market companies with high quality fundamentals, things like strong return on equity, steady earnings growth, and low debt. If we continue scrolling down, we can see the top three holdings within this one are Nvidia at 6.8%, Apple at 6.1%, and Microsoft at 5.2%. You might notice that these top three holdings are exactly the same as my UBS Factor MSCI USA Quality ETF. But I honestly don't mind having stocks that overlap between my ETFs. In fact, I welcome it when it's companies that I consider high quality. If I'm doubling down on names like Microsoft, Nvidia, or Apple, I'm more than happy to do so. If we do have a look at the sector breakdown, it is different to the UBS Factor MSCI World ETF, as we have 23.4% in industrials for this one, 20.7% in technology, and a bigger chunk into financials at 17.2%. If this ETFs sound interesting to you, keep in mind its focus on high quality companies across developed markets, its sector and geographical diversification, and the fact that it uses an accumulating dividend policy. As always though, it's worth making sure it fits your own goals and risk tolerance. We then have my worst performing ETF this month, but again, not of any major concern, with it only being down 1.16%. This one is my X-Trackers MSCI World Momentum ETF, stock ticker XDEM. This ETF tracks the MSCI World Momentum Index, which focuses on large and mid-cap companies around the globe that are showing strong momentum. If we have a look at the top three holdings within this one, they're quite different, with the top holding being Broadcom at 5.7%, Palantir at 4.2%, and then the JP Morgan Chase & Co Bank at 3.4%. When looking closer at the sector breakdown, we can see this one also has industrial at the top position at 24.6%. We then have financials at 23.7%, and then it's followed by technology at 18%. This ETF makes up 20% of my portfolio, the same allocation as my XDEM position, and with momentum investing, it's all about chasing stocks with strong recent performance trends. From my experience, when the overall market is moving up, this fund can capture some really solid gains, but when the market does dip, the volatility definitely increases, and this was shown again this month, considering that this one did underperform the S&P 500. And finally, we have my S&P Small Cap 600 ETF, stock ticker ISP6. This one was actually my best performer for the month, and it is my smallest holding at around 16% of the overall portfolio, but I'm slowly averaging this down to around 10%. This ETF has been on a bit of a rally lately, as for quite some time it was in the red. Finally, this one is into the green, and I'm happy to continue holding it in the portfolio. I did used to have a 15% allocation to this one, but I prefer a slightly higher exposure to XDEM and XDEQ, so I've decided to move this one down to around 10%, which for me is more than enough for the small caps. Over the past 6 months though, it's actually been my second best performer in the portfolio, being up 16.46%, so hopefully it can continue with these big gains. This fund tracks the S&P Small Cap 600 Index, which is made up of 600 smaller US companies that gives me exposure to a corner of the US market that I probably wouldn't invest in directly. As we can see, their top three holdings are SanDisk Corp at 2.6%, BlackRock Liquidity Agency at 0.9%, and SPX Corp at 0.7%. When having a close look at their sector breakdown, they also have industrial at the top position at 28.4%, followed by financials at 11.6%, and then this one has consumer in the top 3 at 7%. And a quick note of caution here, small cap stocks are naturally more volatile and less liquid compared to large cap companies, so they can be a bit unpredictable. It's definitely worth keeping in mind and making sure it fits your own personal risk tolerance if you want to have a look into investing into this ETF. And now if we have a look at the overall gains since starting the portfolio, we can see that it's really shaping up nicely. The best performer is my Xtrackers MSCI World Momentum ETF, which is up around 24%. It's then closely followed by my UC99 ETF, which is up 22%. And then we have the Xtrackers MSCI World Quality at 16.7%. And then we do now have the iShares S&P Small Cap 600, which is in the green and is up 6.81%. Moving forward, I'm just going to continue adding to my positions at the new set allocations. So without further ado, let's put this month's £100 investment into the portfolio. As we can see, I'm going to be putting 50% into the UBS Factor MSCI ETF, 20% into my MSCI World Quality, 20% into my MSCI World Momentum, and then 10% into my S&P Small Cap 600. And there we have it, another £100 added to the portfolio. I really enjoy making this series because it shows how powerful consistency can be. By simply adding £100 every month, this portfolio keeps growing and it builds that healthy long-term habit of investing. Remember, it doesn't matter if it's £100, £50 or even £10. Investing whatever you can each month makes a massive difference over time. Wealth isn't built by timing the market, it's built by time in the market. Patience and consistency are what turns small seeds into lasting wealth. And that wraps up this month's InvestEngine Portfolio Update. If you found this video helpful, don't forget to give it a thumbs up and subscribe for more monthly updates, dividend news and investing tips. Got any questions or want to share how your portfolio is doing? Drop a comment below. I read and reply to every single one. Thanks for watching, and as always, stay consistent, stay patient, and let your money work for you. Until next time, this is the Geordie Pig Investor, over and out.